You hear it all the time, right? The S&P 500 hit a new high, or the Dow tumbled today. We kind of know these are the scorecards for the stock market, but do we really get what's going on behind that score? Today, we're going to decode all of it, how these indexes are actually built, and what it really means for you as an investor.
I mean, seriously, what is the market? For most of us, it's just a number on a screen, maybe a green or red arrow. But if that's all you see, you're missing the whole story, the mechanics behind that number, and how they can directly affect your money.
But here's the good news. It's way less complicated than you think. And honestly, getting a handle on this is the real first step to becoming a smarter, more confident investor.
Think about it. Do you really want to spend all your time and energy trying to find that one winning stock, that needle in a haystack? Or would you rather just own the whole haystack? For a long time, that was a tough choice, but not anymore.
And that's where the stock market index comes into play. It's your ticket to investing in that big picture. But, and this is a big but, not all indexes are created equal.
So yeah, we call it the market's scorecard. It's a fantastic analogy. But let's actually pop the hood for a second and see how that score is really calculated.
At its very core, an index is just a list. That's it. It's a measurement tool, not something you can actually own. The key word here is group or slice. Who decides which stocks get on the list and what rules they use to do it? Well, that changes the entire story the index tells you.
So, sticking with that scorecard idea, if the index is going up, it means the team is winning. But who's on the team? That completely depends on which scorecard you're looking at.
And these are the three big ones you hear about every single day. Look at how different they are. The Dow has 30 companies. The Nasdaq has over 3,000. But look at that row that says weighting. This is the real game changer. The Dow is price-weighted, while the other two use market cap. That single difference has huge implications.
So how do they decide which companies have the most sway over the index's final score? It all comes down to two totally different recipes.
Okay, so on the left, you've got the Dow's method, price weighting. It's simple. A stock with a higher price has more influence. Doesn't matter if the company itself is smaller. On the right, you have market cap weighting, which is pretty much the modern standard. Here, influence is based on the company's total value. So yeah, a $1 trillion company is going to have a much bigger impact than a $1 billion one. It just makes more sense.
I love this analogy for price weighting. It says it all. Imagine a potluck dinner. Someone who brings a $100 bottle of wine gets a bigger say than someone who brings a $10 salad, even if the salad can feed way more people. It just perfectly highlights how skewed things can get when you only look at price.
And that's exactly why market cap weighting is the standard now for almost every major index like the S&P 500. It's just a much truer picture of the economy. Now, the flip side is that this means the performance of just a handful of giant companies, you know the ones, can have a massive effect on the whole index.
Okay. This theory is all well and good, but how does this actually help you invest? This is the fun part. How do you take this scorecard and actually put your money to work with it?
Right, here's the most important piece of the puzzle. You can't actually buy the S&P 500. It's just an idea, a list. What you can buy is an index fund or an ETF. These are investment products specifically designed to own all the stocks in the index and perfectly mirror its performance.
So, you have two main options. You've got the traditional index mutual funds, which are priced just once at the end of the day. Then you have ETFs, which are kind of the newer, cooler version. They trade all day long, just like a stock. For most people, ETFs have become the way to go because they're super flexible, cheap, and often more tax efficient.
And this is the magic right here, the cost. Just look at that number. An index fund costs a tiny fraction of what an actively managed fund costs. Why? Because you're not paying a team of fancy analysts to try and pick winning stocks. You're just buying the whole scorecard. That difference in cost is a huge deal over your lifetime as an investor. And getting started is shockingly simple these days. First, you open a brokerage account online, which literally takes minutes. Second, you search for a fund that tracks an index you like, say the S&P 500. Third, you decide if you want to invest a lump sum or set up a small automated investment every month. And finally, you just hit buy. That's it. You can own a piece of the entire market just like that.
All right, so now you know the what and the how. Let's wrap up with a few golden rules to make sure you avoid those classic beginner mistakes.
Probably the greatest superpower of index investing is that it automatically handles the #1 rule of the game for you, diversification. By buying just one fund, you are instantly spreading your risk across hundreds, sometimes thousands of different companies. It's brilliant.
And because of that, index investing is like a built-in defense system against all these common mistakes. You can't put all your eggs in one basket if you've bought the whole basket factory.
You're not chasing hype or trying to time the market, you're just owning the market. It really helps take the emotion out of it and lets you build a smart, long-term plan. So I'll leave you with this question. The data year after year shows that very few professional investors, the people who do this for a living, actually manage to beat the market over the long run. So why try? Why not just own the whole scorecard? Instead of trying to beat the market, are you ready to just become the market?